So our next panel will be looking at alternative investments, which of course are taking on a bigger role in today's investment world. We have a great panel. Our guests will not only share the focus of their own firms, but also the global alternative investment outlook with a particular focus on risks and opportunities in Asia. The discussion will be led by Ms. Harshika Patel, CEO at the Asia Private Bank of JP Morgan, and our panelists are Juan Delgado-Moreira, co-CEO Hamilton Lane, Goodwin Gore, Chairman and Managing Principal of Gore Capital Partners, Deborah K. Orida, President and CEO, Public Sector Pension Investment Board, and Jeffrey Perlman, CEO of Warburg Pincus. So please give them all a warm welcome as they come to the stage.
Okay, well, good morning, everyone, on this gloomy day. I'm Harshika Patel, delighted to be here. My job as moderator is extremely easy because, firstly, I'm with a highly opinionated bunch, and secondly, I'm told that they are the A-team of the alternatives world. So therefore, I'm sure they can talk amongst themselves and I can simply just take notes. In all seriousness, the whole alt space, as you've all heard yesterday in today's earlier session, it's an area which has enjoyed explosive growth. And in fact, if you look at the next 3 to 4 years, an area that's expected to double in terms of assets under management. Now, as I was walking over here today, I did think to myself, it's a gloomy day, number one. Number two, it's a panel about alternatives. So how do I introduce these wise, panelists of mine in an alternative way? So do humor me, because I consulted my best friend ChatGPT, applied a bit of prompt engineering, and this is what we got, okay?
Totally unscripted.
Here we go. Yes, I didn't tell them about this, by the way. So, in the heart of Hong Kong's financial domain, where investment prowess really does reign, 4 veterans gather, collectively managing 440 billion USD, surpassing Hong Kong's GDP. Jeff Perlman, the visionary, with a mind so keen, Juan Delgado, with strategic precision that never goes unseen, Goodwin Gore, the master of deals and sway, Deborah Orida, guiding where diversification leads the way. Their journeys in Asia and beyond, a tale to be told. In the world of finance, their stories unfold. At the Banker Forum, where insights will shine, guiding us through the evolving investment line. There you go. Thank you, ChatGPT.
Fantastic.
Okay, so with that, now we get down to serious business, Juan. And since you're sitting directly to my left, I thought I'd start with you. Firstly, a huge congratulations. So Juan now is the co-CEO of a global company, Hamilton Lane. You're doing it here from Hong Kong, so I'm sure your hours are just as pleasant as mine. Hamilton Lane has been in this space advising, clients on the whole alternative space for almost 40 years. Yesterday, in an earlier panel, we'd heard about the explosion. We hear about private credit, real estate, infrastructure. So alternatives captures so many sub-asset classes. Do you mind, for the broad audience in the room today, just helping us unpack that and why we are where we are today?
Sure. Thank you. I have to say, it's the first time I feel totally upstaged by the moderator.
I'll take that as a compliment, Juan.
Absolutely, as well you should. So we did script this piece that comes now. Well, I think you heard yesterday in the panel that we should abandon the word alternatives, and I think that's really, really relevant for a number of portfolio considerations. But just to really paint the picture, we are not really the lion that has been described. We're more like a little cat in a corner. So, for example, last year as an industry, actually this year, annualized, we'll raise, so fundraising will be about $1 trillion. That's not even 2% of the market cap of the S&P 500. And that's not a horrible year. That will be a top 10 year in the history of the asset class. And no, that's not just PE. That's PE, venture capital, real assets, credit, all of it. And no, I'm not wrong. So it's not as big as you think. There's many ways to skin the cat. Oh, Juan, you mentioned fundraising, that's down. How about NAV? We all read the report that there's trillions of dollars out there that can never be sold, and so gotcha now. Let's take the high number, around $9 trillion. Again, everyone likes to talk about the buyout side. It must be the biggest. It's not. Buyouts are less than 45% of that. So again, it's not what I say or what Mark Rowan said yesterday. The asset class is really widened over the last few years. What is the other half, Juan? Nearly equally split between venture, again, real assets, and credit. Everyone loves to talk about the credit guy swimming naked. No, nobody talks about the VC guy swimming naked, even though most of the times they are the ones swimming naked. The point I want to make is the largest growth of that $9 trillion, the largest part that has grown most dramatically over the last 5 years is venture and growth. You have nearly $1.9 trillion. So whenever you read some of those reports about the aging of recent investment in alternatives, that's the pig in the python. It's not credit, although it's very relevant, or perhaps more directly relevant. Nobody comes across nicely as criticizing the venture industry, which is not my intention at all. But that's just some big numbers. Last one I'll give you of my scripted remarks. I can't recite the poem like Harshika, but we'll try later. But the other element is liquidity. Again, lots said about liquidity has been very down this year, although it has improved. And I'm not going to make any remark about the future until I get asked the question in a minute. But I think that people forget that the record year of 2021, the volume of liquidity in private markets, again, real estate, private credit, venture, was $1.6 trillion. So we have, as an industry, in 1 year, nearly liquidated a dollar amount equivalent to nearly the entire book today of net asset value in buyouts. So all we have to do, quote unquote, all we have to do is easy for me to say, is just get back slowly to levels of absolute dollar liquidity we have seen. So I'll stop here. Obviously,
so can I just ask a quick follow-up question? So alternatives equals private equity, venture, infra, real estate. What about hedge funds?
Hedge funds, in many respects, are not counted on the statistics,
right,
and they are seen as much more liquid. I like the way it was approached yesterday, which I think is the one that sticks. And in the panel this morning is liquidity versus illiquidity, right? And it's a continuum, it's not a discrete, bright line. And up to this point, hedge funds have operated in structures that are on the more liquid side of that. Now, that continuum is getting breached from the illiquid side, but more and more liquid structures. So I think over time, we'll have a much closer relationship between the two. But in terms of the allocation of role that I described in the statistics, hedge funds have been on the liquid side of that consideration.
Right. Okay, thank you. So Jeff, another congratulations in store for you. Recently appointed CEO of Warburg Pincus, the oldest private equity firm out there, I believe 1966. So just following up from the question I asked Juan, he referred to private equity. I think one of the panelists yesterday talked about the number of people employed in the private equity industry, talked about the number of companies who are, which are private in the US versus public. And there was one quote that I thought was actually quite relevant, which I wanted to zone in on this question. It's not hard to make investments, but to do it consistently is very hard. And you guys have been doing it consistently. So how do you make wise investment choices in the PE space consistently? That's point one. Second question, clearly there's been ups and downs in the PE world. I think, once again, the phrase used yesterday was the industry was declared dead on many occasions, late 80s, 2000, and then more recently. Is it PE's time to come back?
I probably should have brought a pen and paper to write down those questions, so you'll have to refresh me if I get it wrong. First, obviously, thanks to Eddie and the HKMA team for having us. Look, I would say on how we think about investing and having the longest kind of continuous track record of investing in the industry, I think for us it's always been about a core principle of diversification. You heard it on the panel right before this. I think our ability as we've had many panels over the last kind of day and a half, there's a lot of uncertainty out there. and it's very hard to predict the future. And I think because of that, I think the core principle of diversification, I think, really gives us a lot of protection. And I think one of the areas where you've seen the industry kind of lose an element that it's had over time is persistence, right? Persistence is very much faded in the industry, and part of that is everyone just focused on the US, or just focused on tech in the US, or just focused on venture tech in the US. And as a result, the liquidity element has been very challenging, right? You haven't been able to sell much in your portfolios. The industry has basically delivered 50% of its historical average in liquidity in 22 and 23, and probably 24 is not going to be far off from that. I think the ability to be diversified has allowed us to continue to find things to sell in the portfolio that are uncorrelated over time. So I think that's one huge benefit of it. I think the second is really a dynamic allocation model of investing, right? Things change. Sector diversification, geographic diversification. I'd say coming out of COVID, we've probably been more mature market centric, right? Given the repricing that's gone on in a number of these markets. And also they're the deepest, most liquid markets for exit. So we've really prioritized those, and I'd say probably our 14th flagship fund right now is probably more mature market centric than it's been in the previous few funds. At the same time, from a sector perspective, you always have episodic changes in the market. Take financial services. Obviously, coming out of Silicon Valley Bank a year or so ago, that was a great opportunity for us to step in. And one of the areas we love about financial services is it's like the least competitive area of private equity, right? 20% of the economy is in financial services, but yet it's 2% of the dollars raised in private equity. So for us, it's really twofold. It's the importance of diversification, but also having a dynamic allocation model that you're not forced to kind of just deploy capital if you're not really that comfortable from a risk-reward perspective.
And yesterday, Jeff, we heard about also finding the right talent and capabilities. In this world's highly competitive place, how do you ensure that you attract them and keep them?
Yeah, look, it's an excellent question. I always say we're in the human capital business, and when I think about our firm and the differentiation, one question I routinely get is, do you want to be public? And my answer is always the same, which is if I ever felt like we'd be at a competitive disadvantage, of course I would feel the need as a leader to look at that closely. I'd say at the minute the opposite is true. I think it's really been a competitive advantage for us to continue to be an investor-first private partnership, both because I think this perfectly aligned triangle that's worked for us for nearly 60 years. When our portfolio companies do well, our LPs do well, and we do well in the process. And I think it's really important to continue to maintain that. I think the second is on the investing talent. Investing talent wants to be in an investor-first firm, right? They want to find the needles in the haystack as opposed to maybe just buying the market. And I think that's been a huge attraction for us. And also our aligned ownership model. Everyone eats from the same pie, and I think that encourages great collaboration and a willingness for people to want to stay and invest their career at Warburg Pincus.
Fabulous, thanks, Jeff. Okay, so from switching from providers of alternative solutions to Deborah, an allocator. You've been in the whole, Canadian pension fund industry for a very, very long time. And apart from US endowments, actually, the Canadian pension fund industry has been a big allocator to the alt space for quite some time. Actually, if I look at the averages, it's almost like 30% of portfolio allocations to alternatives versus pension funds in this part of the world, which are high single digits, if that. So how did you guys start that journey so early?
And I would actually say that because we started early, in a lot of areas, we're not just an allocator, we're a direct investor. So for example, we've been doing infrastructure investing directly for almost 20 years. We've been in private credit since, PSP has been in private credit since 2015. And those direct capabilities coupled with in areas like private equity, picking great partners has allowed us to deliver good returns that support the pensions that we fund. So PSP 25 years ago was 5 billion Canadian dollars, and now we're 270 billion Canadian dollars. Over half of that is in private markets. So 10 to 15% in private equity, 30% in real assets, which is infrastructure, real estate, and what we call natural resources, which is about 70% agriculture, and 10% in private credit. And those alternative asset classes give us not only diversification, as ChatGPT has pointed out, but...
No, that was my prompt engineering, by the way.
But also deliver to us factor exposure that is valuable to back the liabilities that we're looking to fund, the pension liabilities, right? So for example, from infrastructure, we get not only inflation protection, but also stability. And natural resources or agriculture, we get diversification that really adds to the stability of the fund overall, which is important for us as a pension investor. So I think that when you ask, how did it start? It's really about asking ourselves, what liabilities are we funding? How do we best build the best portfolio to fund those liabilities, and I guess the early mover advantage that the Canadian pension funds had in building some of these capabilities.
How did you get your trustees comfortable almost with that first mover advantage? I mean, Juan talked about some of the risks, perceived risks in this asset class. We heard about it yesterday as well. So how did you convince everyone that this was the right thing for a pension industry, which is typically looking for safe returns as well?
Yeah, I will say, I joined the industry about 15 years ago, and at that time we already had an approach of diversifying into alternatives. So I wasn't around when the original convincing had to happen, but I will say now that the returns speak for themselves. The stability of the returns that we've delivered, the benefits of diversification to our portfolios, and the opportunity that we give our beneficiaries and contributors to get the benefit of partner and investment selection, of the opportunity to do value creation, which adds value over what's available in the public markets, and given the long-term nature of our liabilities, the opportunity to harvest the illiquidity premium.
Great, thank you. Thanks, Deborah. So Goodwin, moving to the sexy industry that is real estate. John Gray talked about falling in love with real estate all over again. It's been a sector that your family has been in love with for a very, very long time. You fell in love with it personally in the mid-1990s. How has real estate investing evolved since the mid-1990s to today? And how do you approach this sector differently when you think about the decision-making back then to today?
Well, it's quite different, right? So obviously, Chinese love real estate. If you go across Asia, you go across any city or any country that actually where the businesses are dominated by Chinese, we tend to believe bricks is a better storage of value than actually cash in banks, right? So historically, that's the context. But obviously, things have changed because the way we live, the digital world we live, which as a result, the way we consume real estate is very different. And because the way we consume real estate is different, we have to think about how the real estate of tomorrow will weather the storm relative to how our lifestyle is changing. And from that point of view, I think one of the questions you were going to ask me is, how do we think of how to allocate investment into real estate today? And I would say, I think of it in three themes, right? One theme is distress, one theme is actually growth, and one theme is geopolitics, which leads to China plus one. On distress side, it's relatively easy to figure out because US in particular has a system to reset itself very, very quickly. As a result, value do drop very rapidly, and they tend to then pivot and rise very, very rapidly. In fact, many of our banking friends here, the new guy always want to write off everything the old guy did, because then he gets a much easier way to write back the write-offs to get his bonuses, right? So because of that, you actually are able to get some interesting reset. And case in point, The one area I like the most is what everyone hates office and everyone hates San Francisco. I said, that's actually what I want to go back in, purely because everything is about data center, AI, power, everything is about AI. And where's the global hub of AI innovation? It is San Francisco. Stanford, Berkeley, UCSF, you name it, all the talent is there. And then also these AI companies these days need to be collaborating with each other rather than being a closed garden ecosystem of Silicon Valley. That's one. Secondly, and then on distress, right, we have been doing quite a bit in Hong Kong on the credit space, but more because we're trying to fill the space where the big banks want to get out of. They want to reduce exposure to real estate. They want to reduce exposure to a lot of the high net worth Chinese developers, real estate in Hong Kong. And Hong Kong being a very robust and easy place to actually enforce your rights has been a very good area for us to participate. And then secondly, I was thinking China plus one. That's a relatively easy one, right? While you think the geopolitics is putting a lot of pressure and stress on Hong Kong, at the same time, it's creating a lot of opportunities in ASEAN. As Victor said yesterday, all the linkage is now, instead of one-to-one China to US, manufacturing floor to the consumer, it's actually multiple. So we have been very focused on ASEAN. And as I looked around the world, China plus one means Mexico is going to do very, very well. So we're buying warehouses on the Mexico-Texas border, because there are so many Chinese factories opening new factories in Monterrey, Mexico. And then obviously Vietnam is a very big beneficiary in Southeast Asia in particular. And then lastly, on the growth side, right? Other than data center that everyone talked about, we don't have to repeat it. I think you see there's a reason why Bernard Arnault at LVMH has been investing heavily in travel, luxury travel in particular. As we mentioned earlier, Laurent mentioned earlier how much money is in the high net worth space. Experiential travel is becoming a new luxury. And that's why Oriental Express is launching trains. All these luxury new cruises are being launched. So experiential travel is becoming a new luxury, and that's going to be a sector that you can actually have a lot of growth in Southeast Asia and also in Southern Europe, just because of cheaper labor, authentic experiences, and high margins.
So Goodwin, I hope I get mates rates when I stay at one of your hotels anytime in the future.
Please visit the region. Best view in Hong Kong.
You're not supposed to be plugging your business, Goodwin. That's my job. Anyway, swiftly moving on.
It's always the tough act to follow.
Oh, they're good, aren't they? I told you they're opinionated. Okay, looking forwards, Juan, I think the previous panel slightly touched on this, which is the evolving investor community in the whole alternative space. I mentioned it in Deborah's question. Endowments, US endowments were first, the US pension funds, and certainly US led the way, and now we can see it coming to Asia, and including a broader range of allocators, insurance companies, high net worth. Can you talk about, firstly, how that journey has evolved? And then number two, as you solve for some of the themes like liquidity, and particularly like high net worth needing liquidity, how your product suite has evolved accordingly, for example, evergreens.
And do all of that without selling my own products.
Precisely.
I would
say nice things about JP Morgan
yes,
Private Bank.
And we have 5 minutes we need to get through. I will just caveat slightly the lead in that in Asia, all of the above has already happened. Perhaps with the exception, I'll come to the evergreen, but obviously appreciating our distinguished hosts, we've had leading institutions in Asia invested in private markets for 16, 17 years. It's nothing new, and it's not unique to the leading institutions in Hong Kong and in the region. It's been mentioned as well, the shift to defined contribution, again, something that has played out sufficiently in the world. The leading DC markets are long established and invested in alternatives, in private markets, Australia, Canada, Israel, Chile. So it's very, very widespread. The whole discussion about target date funds and 401k is a very US-specific conversation, but we shouldn't take that to mean that we're still expecting to catch up conceptually. In the UK is going through its own process of introducing private markets in DC through a procurement process, but that's more to do with the structure and the cost and the procurement in the market with the ability of private markets to perform in those contexts. So that said, it is relatively recent to have semi-liquid structure, so-called evergreen or open-ended. And the main reason, as I like what has been said in the panel, is returns. Returns is why we're here. we're overall experiencing this growth because the asset class has delivered returns. And of course, in the last few months, with the S&P 500 having this amazing run and the Trump bump and all of those things, it doesn't seem necessary, but people very quickly forget the experience of the last 3-4 years. So because of returns, we're dealing with this arrival of the high net worth. And we have just copied, to your question earlier, the industry just copied the hedge fund model here. The structures are very similar to the subscription models of hedge funds. And by the way, they were not invented yesterday. One of the other funny paradoxes is that there have been funds with these structures for 15 plus years. They just become popular. So I'll leave, conscious of time, with my final remark is, I think rather than the industry appearing or being reported to be pushing product into a different constituents, also sometimes making us practitioners feel like we don't like our institutions. We love institutional investors. That's all we do since 1991. But the point is, the industry is responding to a demand by institutions such as your own and many others to deliver the same level of returns in a format that is slightly more liquid. And again, conscious of time, I'd say the jury is out there, you could say, because of the absence of a major crisis. But so far, it's pretty successful. Again, we've operated our own. We are one of the top 5. We run over $9 billion. We started in 2019. I don't need to remind this audience what has happened since 2019 to today. I wouldn't call that a smooth ride. And so we've had a monthly NAV and monthly liquidity for the last 5 years.
Great, thank you. Jeff, a country that we didn't talk about too much yesterday or in the earlier panel, but too big to ignore. I'm from there originally, India. You guys have done a phenomenal job in India. It's not an easy country to navigate from an investment point of view. 1 minute on how you've done it and why you're so excited about it.
Look, India, to your point, is certainly been the big topic of conversation for many investors. We've been there nearly 30 years. And I think one of the keys to success, and this is really true across Asia, is really being local. You have to be kind of local, both in the entrepreneur community, the ecosystem, who to invest with, when to invest, and more importantly also when to look to take liquidity. And one of the great things about India right now is that investment flywheel is working as well as almost anywhere in the world, maybe on par with the US. The IPO market's probably the best in the world right now. Continued strength in public markets attracts more investors to want to deploy more capital. And then obviously allows other strategics to want to step in front of some of those companies looking to go public. So the flywheel's worked incredibly well. We've used that to actually also monetize a bunch of our positions through the public markets, but continue to find really compelling, attractive opportunities to continue to deploy capital. And I think as capital has been diverted across the region, India no doubt has kind of been a beneficiary of it.
Okay, thank you so much, Jeff. Deborah, it's a big question, but 1 minute to answer it. Obviously, geopolitics, macro challenges, monetary policy, quite challenging. Once again, as an allocator of capital, how do you think about all of these factors on how you think about allocating capital?
I think actually the complexity of the investing environment makes diversification even more important. I think that our diversification across public and private markets, across geographies, is really important. And even within the alternatives, the diversification across the asset classes, because private credit behaves differently than infrastructure, than our agriculture assets, for example. And that diversification is really important in an uncertain world. I think the other thing for us is really focusing our own active management and direct capabilities where we have long-term conviction and developed expertise. So in areas like infrastructure, where we've been in it for decades, in areas like private credit, where we've been there for almost 10 years, really focusing on those areas and thinking about where there might be opportunities to leverage that expertise. So for example, infrastructure debt. is a combination of the credit expertise, where we have a long history, and the infrastructure expertise, where we have a long history, and looking at the infrastructure opportunities across the capital structure and being able to make that decision about where the best relative value is an opportunity that we think is important, and important when capital rushes into certain asset classes and you want to be able to have other ways to leverage your expertise.
Great, thank you. So Goodwin, it's a gloomy day. I started with a poem to lighten the mood. We're in Hong Kong. Can you talk a little bit about People's Place?
People's Place, it's actually a collection of 27 shopping centers that caters to the middle to lower middle class of Hong Kong. It's a bit unique to Hong Kong. These are assets that actually, shopping centers that sits below these housing estates that are catered to subsidized housing projects. So this is a portfolio of assets we put together, obviously catered to the masses. And what we did, as I go back, real estate is still product, right? Real estate 101 is still about product. So when we looked at that product, when we bought the portfolio, we looked at it, we said, how do we actually use this product to make the life of the people who live in those places better? If we achieve that, the rent and the cash flow will take care of itself. So the one thing we did, many of these malls have a rooftop sports court, but they were dilapidated over the years. So all these 22, 24 towers look down on these rooftop sports court, dilapidated. So what we did was actually we brought in creative Hong Kong designer, grew up in this housing estate, and actually fixed 3 or 4 of them to start, to actually create some, we say, how do we create hope through sports? So the first step is how do we get some love or show some love? When we did that, we actually brought a lot of kids to play in the playground. The grandmothers were able to actually hang out in the shopping center and eat the food. And then we had restaurants to actually come up with awards for kids who get good grades in those public schools. We started by doing that, and then we got corporates to actually help us fix those courts after we fixed 3 or 4. And then we teamed up with an NGO to start a basketball league for kids 14 and under. Started with boys team and then girls team. And we started with 7 of our teams to allow these estates to have teams to play against each other on these beautified courts to create a league. And that league is now 28 strong on women's and boys. And many of these malls are no longer ours. Some of these are actually our competitors saying they're going to fix up their court and join the league. And I think we did achieve that. So it's back to Real Estate 101. And as a result, also, you don't read in the newspaper about the rents going up in these centers because the increased footfall, increased revenue actually more than make up for the increased rent.
Absolutely love it. Uplifting communities. Thank you, Goodwin. So before I let you go, we're coming up to 2025. So I'm not going to ask you where you'd invest $100,000 because everyone's been asked that question. Right, quickly, your New Year's resolution. Investing New Year's resolution.
No, I will invest it in my evergreen global private assets. I mean, that's
your New Year's resolution?
that's a New Year's.
Okay, perfect. Goodwin.
You're negative 4 minutes.
I know, but moderator's privilege.
Well, in a higher for longer interest rate environment, likely inflationary policy from the new president-elect, you actually have to go back to Real Estate 101 and find buffers, how to create value through fundamental in real estate investing again.
God, they're all talking their own book. Deborah.
I will talk my own book. I think that my New Year's resolution would be to invest with focus and foresight, to leverage our structural advantages, and to make sure that we're working with great partners.
Great. Final word, Jeff.
Focus on pricing power. I think to Goodwin's point, worried about inflation, you've got to be able to kind of find businesses that can pass through that incremental cost to customers and protect margin. So for us, very focused on pricing power for businesses.
Great. Thank you so much. Ladies and gentlemen, a huge round of applause for our wise panelists.